Let's get across the market open now with Kyle Rodda from Capital.com. He is live. Kyle, thank you so much for joining us. Look, we can talk about what happened on Friday, but I think more interesting is all that's to come this week. I mean, we are central bank heavy.
Yeah, and I mean, it's been the last fortnight or so that we really have seen the kind of last of the central bank meetings for the year. And largely speaking, that kind of continued global cutting cycle is underway, and it's more or less expected to continue this week. So the Fed's going to be the highlight. We've got the Bank of England and the Bank of Japan as well, which will be a bit out of step with the rest of the world because there's no chance, obviously, a cut, maybe even a slight possibility of a hike from the BOJ. But it looks like the Fed's going to go 25. The market's going to be looking for guidance going into 2025, of course, because there are all these signs that potentially inflation's a bit stickier, and there's a few further inflation pressures coming down the pipeline. But I mean, nevertheless, we talk about Santa Claus rallies this time of the year. The difference will probably be in the commentary of what the Fed says or doesn't say as to whether we continue to see this kind of market push higher in the United States and maybe build on these record highs. And a very, very good year for equities, it has to be said, with the S&P 500 up by about 25%.
Yeah, it has been such a year for Australian investors as well. Locally, we get PMIs today. What else are we keeping our eyes on now as we really motor towards the end of the year?
Well, I mean, it's interesting because last week was obviously a pretty poor week for the markets. Other than like a 2 or 3 point gain, I think it was on Monday or Tuesday, we basically saw declines every day of the week, and quite substantially as well. So we're sort of looking at a little bit of caution across the ASX 200 coming into the end of the year. But you have to obviously put that in the context that, although we haven't seen the same returns as US equities, we're looking at potentially 10, 11, maybe 12% gains for the benchmark index here, which, historically speaking, is very robust. It goes now to the question, which, locally there's not going to be that many drivers to drive the market for a couple of weeks now, especially now that the RBA is out of the way, and obviously we don't have that much corporate news. But it's going to be about sort of, how can the market justify these valuations, especially some of the market's heavyweights going into a new year. And the risk that potentially there could be some more volatility ahead and less robust fundamentals, at least domestically. So, you look at stocks like CBA that are trading at sort of $160 per share, and historically rich valuations. Investors are going to have to sort of start to consider whether they start pocketing some of the returns from what has been a really robust year, and sort of waiting on the sidelines going into the uncertainty of the new year, or whether they continue to buy into this rally. I suspect in the short term it'll be an international story. If the Fed cuts and they're a little bit more dovish, or whatever it happens to be, that's going to have that sort of impact in the short term in terms of price momentum. But for those investors looking into the new year, it's going to really be about whether they continue to hold these positions if they're starting to look, relatively and even really on an absolute basis, quite rich historically speaking.
Yeah. Okay. Yeah. And today we do get data from China, and there are still, really high hopes when it comes to the stimulus story there, and we saw it reflected in some commodity prices as well.
Yeah, high hopes and underwhelmed expectations, I think, is really what's happened for the markets with China recently, and certainly over the last couple of weeks. Every time we see what increasingly looks like jawboning from China's authorities when it comes to boosting asset prices, maybe boosting animal spirits, household sentiment in the economy, the markets are buying into it less and less, and they're looking more for a little bit of action, or the authorities to start sort of walking the walk rather than just talking the talk and delivering on some of these pledges of moderately loose monetary policy, and seeing what that actually means tangibly, seeing actual measures in terms of the proposed 3 to 4% deficit spending, where that actually goes and how it's going to benefit the economy. We'll get a bit of a growth update today, which will obviously give us a little bit of a pulse check on how the economy's been over the last month, whether some of the tweaks in policy settings over the last few months are starting to manifest in fundamentals. But I think overall we're still seeing a picture that is a little bit gloomy for China's economy. The retail sales number will be very interesting, especially on the back of the CPI figures that we got lately, that shows that households are still really under pressure. And I think now, rather than just reacting to perhaps backward-looking data as well as these promises of stimulus, investors are going to be looking for really tangible measures before they start believing in Chinese markets again, and are willing to sort of buy into equities, Chinese equities, at a time that, again, the structural story is really bad, the secular story is still really bad with some of the challenges that the economy faces, and now they're running into a new year which could potentially involve another trade war. So important data today, again, because it it'll give us a sense of what impacts the kind of tweaks to stimulus that we've had over the last few months may have had on the economy. But there's just this yearning for more, and I suspect that investors are going to be far more skeptical about, again, authorities jawboning going forward.
So today, no Santa Claus rally in the stars, at least as it looks now.
It wouldn't appear so, and I think the dynamic that we did see on Friday was a bit of a run-up in bond yields, which interestingly, we still saw a bit of a lift in tech stocks despite that, but there is this kind of sense that there's a bit of volatility being baked into the rates markets, there's a bit of volatility being baked into bond markets, really to reflect the positioning going into Thursday's Fed decision and what could come from that. So it doesn't appear that we'll get much love today. Maybe if we do see some upside surprises in the Chinese data, we'll get a little bit of an uplift in those markets and some of those cyclical areas of our market, obviously commodity players, miners in particular. But you would suspect there'll be a little bit of caution over the next couple of days going into, obviously not just the Fed, but also things like the Bank of England and the Bank of Japan, before effectively we digest what happens on Thursday morning and investors decide whether they'll sort of buy into the bull market to round out the year. So yeah, cautiously optimistic, but certainly doesn't seem like we're going to see local equities sort of take off and make another push and recover the losses that we saw last week.